All right, let's dive right into Canopy Growth Corporation's fiscal 2026 Form 10K. If you've been following the cannabis sector, you already know it is an absolutely wild ride. We're talking relentless regulatory hurdles, massive financial maneuvers, and incredibly fierce competition. Today, we're cutting straight through the noise. We are going to use Canopy Growth's own official financial disclosures to see exactly what is happening under the hood. What we're decoding today is their official SEC Form 10K. Sure, it's an intimidating document full of complex corporate governance and regulatory compliance, but it is essential. The 10K is literally the ultimate source of truth for public companies. It strips away all the marketing fluff and forces management to lay out the raw financials, the operational realities, and most importantly, the risks. For Canopy Growth in fiscal 2026, this document is an absolute goldmine of strategic shifts and accounting realities. Now, the contrast here is wild. Right up front in this dry, heavily regulated document, you hit this incredibly bold corporate vision. They state, "We are here to better lives through cannabis. We believe in the power of a plant, not as a trend or commodity, but as a catalyst for elevating human potential." It's an amazing consumer-facing mission, right? But as you'll see, actually executing that vision requires navigating an absolute labyrinth of global regulations and financial engineering. So here is our roadmap for this explainer. First, unpacking the 10K filing. Second, the financial restatement explained. Third, building a global brand. Fourth, navigating the U.S. market. And finally, debt, equity, and acquisitions. Let's get to it. First up, Section 1, unpacking the 10K filing. Basically, this entire document reveals a fascinating dual reality for Canopy. On one side, they are hyper-focused on building these beloved consumer brands using an asset-light operating model. But on the other side, they are managing a highly regulated public entity across international borders. Every single product launch, every expansion, and every financial move is just heavily scrutinized under both Canadian law and incredibly strict U.S. securities regulations. Moving on to Section 2, the financial restatement explained. Okay, we've got to tackle the elephant in the room right away. The audit committee identified what's called a material weakness in internal controls. Basically, this means there is a reasonable possibility that a material misstatement in the financials won't be prevented or detected. You know, it's a phrase that absolutely always makes investors sit up and pay attention. Management, all the way up to the CEO and CFO, had to formally conclude that their internal controls over financial reporting were simply not effective as of March 31, 2026. So what exactly went wrong? It really boiled down to a hyper-specific currency issue. U.S. dollar-denominated share-settled warrants were initially misclassified as equity instead of liabilities. Because Canopy Growth's functional currency is the Canadian dollar, these specific U.S. dollar-denominated warrants, which they first issued in fiscal 2024, couldn't legally be classified as equity. They actually had to be recorded as liabilities on the balance sheet and then measured at fair value at every single reporting date, with those changes directly hitting the statement of operations. Because of this slip-up, Canopy had to issue a massive retroactive correction. Now, to be clear, this was a non-cash technical correction, but the reach was wide, impacting fiscal years 2024, 2025, and interim periods in 2026. This meant completely revising previously filed 10Ks and 10Qs. It's a pretty stark reminder that in the highly scrutinized cannabis industry, absolute accounting compliance is just as vital as plant genetics. All right, Section 3, building a global brand. With the accounting drama settled, let's look at the actual engine of the business. Their product portfolio is massive. They dominate the medical sector with Spectrum Therapeutics, Canopy Medical, and Apollo Clinics. Over in the adult-use recreational space, they've got iconic names like Tweed, Doja, MTL Cannabis, Wana, and Deep Space. And they aren't just selling the plant itself. They own Stores & Bickle, which is an absolute powerhouse in the vaporizer device market, famous for the Volcano and Mighty Plus. They are basically covering every single angle of consumer consumption. And they are way beyond just the Canadian border. Yes, they boast high-quality cultivation sites in places like Kincardine, Pointe Claire, and Louisville, but expanding outward, their global footprint is huge. They are distributing EU GMP-certified medical cannabis and vaporizers around the world, managing medical distribution in Germany and Poland, and even exporting registered therapeutic devices all the way out to Australia and New Zealand. They are positioning themselves to capture market share wherever medical cannabis regulations open up globally. Next up, Section 4, navigating the U.S. market. This is where the strategy gets really fascinating. Because cannabis remains federally illegal in the United States, a company listed on the NASDAQ and TSX simply cannot directly cultivate or sell THC products there. So, to enter the US legally, they used a very clever insulation strategy. They established an unconsolidated entity called Canopy USA as a non-controlling, non-voting entity. Canopy USA holds conditional investments in successful US brands like Wana and Jetty. This keeps Canopy Growth's financial operations strictly insulated, giving them unparalleled exposure to US growth without violating federal law or NASDAQ listing rules. But of course, the whole strategy hinges on one crucial milestone, the stock exchange permissibility date. This is the anticipated future date when major exchanges like NASDAQ or the NYSE finally permit the listing of companies that consolidate U.S. adult-use cannabis operations. Until that day actually comes, Canopy Growth has to keep Canopy USA at arm's length, accounted for as an equity method investment based on fair value. Make no mistake, it is a massive, highly structured bet on future U.S. federal legalization. And finally, Section 5, Debt, Equity, and Acquisitions. Let's be real, running a global cannabis empire burns through cash. It's incredibly capital intensive. In January 2026, Canopy secured a massive $150 million cash injection through a senior secured term loan from JGB Collateral LLC to refinance their credit facility. Now, this liquidity was absolutely critical, but it came with some seriously strict conditions. We're talking an original issue discount, a minimum cash requirement, and a hefty interest rate tied to the SOFR rate plus 6.25%. They even had to issue over 18 million warrants to the lenders. It really highlights just how expensive the cost of capital is in the cannabis market right now. On top of that debt, they also tapped the public markets hard. They raised hundreds of millions through at-the-market equity programs, rapidly selling over 180 million shares to the public to shore up their capital. In fiscal 2026 alone, they generated over $173 million under their February 2025 program and another $98 million under their August 2025 program. While this gives them the essential funding they need for daily operations and strategic moves, it also means significant dilution for their existing shareholders. They are actively using their public stock as currency to fund their survival and their growth. But they aren't just surviving, they're expanding aggressively. You can really see this when you look at the rapid timeline of their MTL cannabis acquisition over just a few short months. They signed the agreement in mid-December 2025, amended it in early January, and fully closed the 100% acquisition by March 16, 2026. This wasn't just about getting bigger for the sake of it either. It was a highly strategic move to execute their asset-right model by acquiring world-leading genetics and incredibly skilled cultivation talent. And what did they get for that? Through this transaction, they brought premium, terpene-rich indoor flower directly into Canopy's in-house capabilities. To make the deal happen, MTL shareholders received 0.32 of a Canopy share and 14.4 cents in Canadian cash for each MTL share. This acquisition directly bolsters their adult-use portfolio, bringing a brand well-known for consistency and hand-finished craftsmanship right into the Canopy family to help drive profitable scale moving forward. So, as we wrap up this explainer, we're left with the big question. Can Canopy Growth's intricate financial maneuvers and strategic U.S. positioning ultimately outpace the immense regulatory burdens and the fallout of their accounting restatements? Think about it. They have the massive global footprint, they have the beloved brands, and they've built a genuinely fascinating insulated structure to tackle the U.S. market. But as their 10K vividly illustrates, the path forward is still completely paved with regulatory complexity and very real financial risk. It's a high-stakes balancing act, and the whole industry is watching to see if Canopy can maintain its footing. Thanks for joining me for this explainer, and remember to always keep questioning what's behind the numbers.